Understanding non-owner occupied properties, an in-depth analysis. What is non-owner occupied? The term non-owner occupied refers to a classification used in the realm of real estate, particularly in mortgage origination, risk-based pricing, and housing statistics associated with 1 to 4 unit investment properties. Simply put, a non-owner occupied property is one where the owner does not reside in it as their personal residence. This classification holds significance beyond its basic definition, affecting interest rates, insurance requirements, and eligibility for various forms of financing. Notably, this term is not typically applied to multifamily rental properties like large apartment complexes. Key takeaways. Classification: non-owner occupied signifies that the property is not the owner's primary residence. Interest rates: lenders typically charge higher interest rates on loans for non-owner occupied properties due to the increased risk of borrower default. Occupancy fraud: some borrowers may misrepresent their intention to occupy a property to secure lower interest rates, a serious issue known as occupancy fraud. Renovation loans: non-owner occupied renovation loans are available for investors looking to purchase and upgrade properties. Understanding non-owner occupied properties. Accurate classification as non-owner occupied is crucial for lenders. It assists them in determining appropriate interest rates for borrowers and compensating for risk. Generally, lenders consider non-owner occupied properties riskier than owner-occupied ones, therefore, they charge higher interest rates on the former. Interest rates and default risk. Borrowers who invest in properties without residing in them are statistically more likely to default on their loans. This higher likelihood can stem from numerous factors, such as changes in market conditions or personal financial difficulties unrelated to their primary residence. Consequently, lenders factor these risks into their pricing models and adjust interest rates accordingly. The dark side: occupancy fraud. Occupancy fraud may occur when a borrower intentionally misrepresents their intention regarding the property's occupation in order to benefit from lower interest rates typically reserved for owner-occupied properties. The implications of being found guilty of occupancy fraud can be severe, including legal action for bank fraud and immediate repayment of the mortgage. To avoid unintentionally entering into such fraudulent territory, borrowers who must rent their owner-occupied properties temporarily should consult their lenders. The role of non-owner-occupied properties in the real estate market. In the real estate landscape, non-owner-occupied properties often encompass single-family homes, condominiums, and other residential types rented out to tenants. These investments can provide financial returns, primarily when properties are acquired at lower prices, need repairs, and can be refurbished for the rental market. Insurance coverage and vacancies. Property owners must ensure that they have appropriate insurance coverage for non-owner-occupied properties. This is critical for safeguarding against potential risks associated with renting to tenants. In contrast, if a non-owner-occupied property remains vacant, a different type of insurance may be necessary, protecting against various risks tied to unoccupied properties. Non-owner-occupied property financing options. Borrowers interested in non-owner-occupied properties can access financing options tailored specifically for these kinds of investments. A popular choice is the non-owner-occupied renovation loan. This type of loan enables investors not only to purchase the property but also to tap into funds earmarked for renovations. Qualifying for a renovation loan. These loans generally assess the potential value of the property post-renovation, rather than the current market price. While there is typically no set minimum repair amount, any renovations funded must become a permanent enhancement to the property, such as a new roof, updated plumbing, or increased square footage. Cosmetic changes alone are not sufficient to justify a renovation loan. Importantly, such loans are usually only available for those owning up to 4 financed non-owner-occupied properties. Frequently asked questions. Why higher interest rates for non-owner-occupied properties? Borrowers that do not intend to live in the property typically face a greater risk of default compared to those living in their homes. To mitigate this risk, lenders impose higher interest rates on non-owner-occupied loans. Should I refinance or take out a loan on a second property? The decision depends on the borrower's equity in their primary residence. Generally speaking, refinance rates for primary residences tend to be more favorable compared to non-owner-occupied properties. A side-by-side comparison of rates is advisable. Can I secure a better rate if I move into a non-owner-occupied property? Should a borrower choose to occupy a previously non-owner-occupied dwelling as their primary residence, refinancing options may be available that offer better terms. However, potential borrowers should weigh the costs of refinancing against the expected benefits. Conclusion. In essence, non-owner-occupied properties represent a significant segment of the real estate investment market, characterized by unique risks and rewards. Investors must navigate complex financial landscapes, understand potential hazards like occupancy fraud, and ensure appropriate property coverage. With various financing options available, including renovation loans, understanding the nuances surrounding non-owner-occupied properties is crucial for successful investment and management. Ultimately, being well-informed can lead to sound real estate decisions that benefit both the owner and the tenants involved.